Bill O'Neill. Bill, in terms of what we're seeing, emerging markets for a long time were considered the safer haven. They're growing, they don't have the debt problems we have here, but actually, you're absolutely right. If we look at the stock performance, they're still underperforming what we see in the developed countries. Is this just because they're not decoupling?
Well, I think that, Francine, there's a number of issues here. First of all, there's the growth story, because what's happening with equities, emerging market equities, isn't happening in isolation. It's also affected emerging market debt. It's affected emerging market currencies. There's been certainly a sellout of emerging market assets at the moment. And you'd have to see this partly down to the issue of the reduced immunity to developed market developments, and also the sense in which a move to US dollar as well, a shift of money back to the US dollar. And certainly if you look now at valuations have moved back very sharply. They're now in a significant discount to the developed world. So you have to say to yourself, is there a growth recession basically being priced in? I would argue yes, there is.
And on China, though, you're also very, very prudent on China. Yeah. Hard landing by 2012. If it falls, if growth even falls to, what, 5-6%, it will mean a huge impact for a lot of the commodity stocks and a lot of our stocks here in the developed world.
Well, I think in terms of China, a hard landing is certainly not given. Our view is that basically it will be a rougher passage than many expect, but still I think we're looking at growth rates around 8.5-9% through certainly the first half of 2012. My argument here is that you're beginning to see the pressure from the monetary tightening that's been in place in China now really for over a year, particularly beginning to affect the sort of more unconventional sources of finance coming out of China, and the dollar squeeze is part of that, or the move back into the dollar. So I think essentially it's still going to be, the key signal here will be what China does in terms of monetary policy, not in fiscal policy. I think once we get a shift in monetary policy in China, which probably will not be till the end of the year, maybe post the G20 summit, that will be a signal probably for money to move back in at a cheaper level. So I think there is a tactical call here around emerging markets relating to the monetary cycle.
So talk to me about what your clients are asking you of you right now. We're come out of the summer months, a lot of volatility to come. What's your main advice to them?
We're getting a lot of questions about drawdown. By drawdown means basically absolute dollars and cents, pounds and pence, losses, protecting, preserving capital. How do we do this? How do we structure our investments to reduce that risk? And we are saying essentially, there's three elements in all this. It's dealing with a low return environment, okay? Dealing with environments where, for instance, yield is going to be a much more important part of your total return. Control.
So what do you mean in terms of bonds?
Bonds,
how much
yield,
would you be putting in bonds, for example?
Well, basically, we're still basically overweight credit. Basically, we're not biased to sovereigns by any means, but we're still looking at the credit sector. Yeah. And in time, emerging market debt. In time, particularly Asia-related emerging market debt.
So that's one of your main topics. What are the other two?
Now, the other two are basically volatility bubbles, so these volatility spikes. And that part of that is actually dealing with things like managing liquidity, acquiring a suitable level of liquidity, putting strategies in place that actually cut off to a degree some of the downside as well, some of the option strategies, spread strategies there as well, and active managers as well, using CTA managed futures, macro managers as well that are very active, and active tactical asset allocation is a big part of this. And also the basic is actually this very polarized environment of risk on, risk off, and how you deal with that, and how you put structure this thing. Liquidity management, total return management, volatility management, managing for drawdown, or a circumstance of drawdown.
But I know it's a difficult question, but how much, in terms of percentage-wise, do you think that we'll see a recession and that risk needs to be off? We're seeing a banking crisis almost repeating itself.
It's recession where? I mean, I still do not believe, a global recession is given. The hard data in the States, 2 months into the shock, is not yet suggesting a recession. It's suggesting a very sluggish pace of advance. It's going to be a very close call in Europe during the winter. I think technically there is a very reasonable chance that we get a recession in Europe.
With the financial crisis?
Well, I think, and you can see this building, basically the tightening in the money markets, the absence of basic access to funding part of the banks, the reduced availability of credit. The big story in Europe will be Germany, how strongly Germany proves to be, how resilient Germany proves to be. in the face of a slump in the periphery.
And so would you be looking at Germany has been actually holding up quite well, which poses another problem for the ECB, but would you be looking actively to buy German equities?
Well, Germany, yeah, but the DAX versus Eurozone, again, you talk about pair bets as a way of actually looking at the world coming out of the slump. That is a useful story. The euro is down at 133, This is a good story for German exporters. Of course, they've been hit on margin. The industrials had a very, very, very difficult story at the beginning of the year. But coming out of this, I certainly think a DAX versus Euro stock story would be an interesting way to play this. But I still think the risk of a global recession is somewhere between 30 and 40%. It is not given.
That's better than some. Thank you so much, Bill O'Neill there, European Chief Investment Officer at Merrill Lynch Wealth Management.